Welcome to the deep dive. If you want to cut through the noise and get straight to the insights that truly matter, you're in the right place. This week, wow, we are plunging into what you could only call the financial markets Super Bowl, World Series, and Stanley Cup, all rolled into one. Seriously, we're dissecting the trading week of July 28th to August 1st, 2025. And look, this is a critical inflection point for the global economy. For you, the listener, you're about to face this formidable gauntlet. A pivotal Federal Reserve decision, the absolute peak of Q2 earnings with all the mega caps, and just a barrage of top-tier economic data. It's a lot to navigate.
It really is. And what's crucial to understand as we step into this week is where the market is right now.
Mm.
Major indices, the S&P 500, the NASDAQ, they're flirting with all-time highs. They've been pushed up by months of positive momentum. Think of it like a car going uphill, maybe a bit too fast, fueled by optimism. You see sentiment indicators like the CNN Fear and Greed Index. They're flashing extreme greed.
Extreme greed, okay. That sounds good on the surface, but I sense a but coming.
Exactly. It signals very high investor optimism, sure. But it also creates this distinctively asymmetric risk profile.
Asymmetric, okay, that sounds important. We need to unpack that immediately for our listener. What does that mean for them specifically?
Great question. Basically, it means the market has already largely priced in the good news, most of it anyway.
Huh.
So any positive surprises from the Fed or maybe stellar earnings, they might offer only limited upside from here because, well, they're kind of expected.
Right, baked in.
Baked in. But, and this is the key part, any negative surprise. Say the Fed sounds unexpectedly tough, or maybe a big tech giant misses on earnings, or even just some surprisingly hot inflation data.
Uh-oh.
Yeah, that could trigger a sharp, rapid repricing. A quick, maybe painful unwind of those really confident positions, because the market just isn't prepared for bad news right now.
Okay, so our mission today is crystal clear. We need to equip you with a strategic roadmap for this high-stakes week. We'll dissect each key event, look at how they might interact, and pinpoint the specific risks and opportunities that could pop up. This deep dive. It's designed to give you a clear point of view, maybe even a well-defined plan.
And we'll approach this logically, step by step. First, we'll navigate the macro calendar, the economic data, see how that sets the stage. Then we'll dive into the corporate health check, those critical earnings reports, can't miss those. And finally, we'll zero in on the Federal Reserve's decision. That's the main event, really. Then we'll pull it all together into, actionable market impact analysis and strategic thoughts for you.
Perfect. Let's kick off then with segment one, the economic proving ground. I like to think of the economic data this week as sort of a sequential story. It first sets the stage for the Fed's big decision on Wednesday, and then, boom, it immediately tests the Fed's credibility. And here's a really crucial point. The market's final verdict, it won't really be settled until Friday's jobs report. That's like the final whistle in that Super Bowl we mentioned.
It truly is a week where each data point builds on the last, building this narrative.
Absolutely. So let's look at the pre-Fed pulse. On Tuesday, July 29th, 10:00 a.m. Eastern, we get two important reports landing at the same time. First, CB consumer confidence. This is the last big read on consumer sentiment before the FOMC, that's the Federal Open Market Committee, wraps up its meeting. Consensus is looking for a tiny dip, maybe 95.0 from 95.5. Still pretty stable consumer mood, right? But what's the Fed looking for here?
The Fed will be scrutinizing this. They'll look for any signs of deterioration, especially in how consumers are feeling about inflation and the job market. A sharp, unexpected drop. That could signal a future slowdown in spending. And that would give the dovish members on the committee, the ones leaning towards lower rates, a bit more ammunition.
Okay, makes sense. And also at 10:00 a.m. ET on Tuesday, we get the JOLT-T's job openings report. JOLT-T's, that's the Job Openings and Labor Turnover Survey. This is a key gauge of labor market tightness, one the Fed really favors. It shows how many jobs are out there compared to job seekers. Market expects a slight decline here, too.
Yeah, and an orderly decline in job openings. That's actually what the Fed wants to see. It suggests a rebalancing is happening, labor supply and demand coming closer together, maybe easing wage pressures. So a figure significantly below what people expect would support a more dovish policy. It signals the labor market is cooling. But if there's a surprise increase in openings, well, that reinforces the higher for longer interest rate story, suggests the economy's still running pretty hot.
Got it. Then we hit the midweek verdict, arguably the biggest data days. Wednesday, July 30th, 8:30 a.m. Eastern. Advanced Q2 GDP. This is probably the most significant piece of data Fed Chair Powell will have in his hands when he steps up to the podium for his press conference later that day. Consensus expects a strong rebound, like 2.5% annualized growth. That's a sharp turnaround from the negative print, the 93.5% contraction we saw in Q1.
Right, and a growth figure around that 2.5% mark. It validates the Fed's current story, their narrative that the economy is expanding at a solid pace. It gives them justification for being patient on rate cuts. But, and this is important for you to watch if we see a weaker number, say below 2.0%, that immediately challenges their assessment. It could force Powell into a more defensive position during that press conference. It's crucial for his messaging.
Okay, so GDP Wednesday morning. Then, the morning after the FOMC meeting, Thursday, July 31st, 8:30 a.m. Eastern, we get the core PCE price index. Now, this is the Federal Reserve's preferred inflation measure. PCE, personal consumption expenditures, they like it because it covers more stuff and adjusts for how people change their spending. This release is like an immediate test of whatever the Fed just said the day before. Consensus is for a 0.3% month-over-month increase for June. What does that mean?
Well, a reading of 0.3%, or maybe even higher, that would largely confirm inflation is still sticky. It validates that hawkish hold idea from the Fed unchanged rates, but a tough stance. That would likely push market expectations for a September rate cut even further out. On the flip side, a cooler print, say 0.2% or maybe even less, that would be a significant dovish catalyst. It suggests inflation pressures are easing faster, and it would dramatically boost the odds of a September rate cut. This really tests the Fed's resolve right away.
Okay, high stakes indeed. Finally, the week wrecks up Friday, August 1st, 8:30 a.m. Eastern, with the July employment situation report, the jobs report. This is the ultimate test, right? The Fed's dual mandate: maximizing employment, keeping prices stable. Consensus is pointing towards a significant cooling. Non-farm payrolls may be gaining just 102,000. That'd be the weakest since February. And the unemployment rate ticking up slightly to 4.2% from 4.1%.
Exactly. And a soft payroll number, rising unemployment, that's the clear evidence of labor market softening the Fed has been, well, waiting for. It's a key precondition for them to even think of cutting rates. However, and this is the crucial variable here, average hourly earnings, wages, they're still expected to rise by a solid 0.3% month over month.
Yeah.
If that wage growth proves stickier than expected, even with weaker job growth overall, it complicates the story. It makes the disinflationary narrative harder to maintain. This is where the rubber really meets the road for the Fed's twin goals.
Wow. Okay, so that's the economic proving ground, setting the whole stage. But the market isn't just about data points, is it? It's also about how companies are actually doing. Let's shift focus now to segment 2, corporate health check, because this week is, like you said, a real referendum on earnings.
You're absolutely right. This week is the peak, the zenith of the Q2 earnings season. Just a dense concentration of reports that can really move the market. Now, we have seen a high percentage of S&P 500 companies, maybe 80% or so, report earnings per share above the estimates, which sounds good, but the size of those positive surprises, the magnitude, it's actually been below historical averages. And what's more, the overall blended year-over-year earnings growth rate for the index is tracking at its lowest level since Q1 2024. So this sets a really high bar, especially for the market leaders. Yeah, let's talk about the Tech Titans test, because the market's climb this year, let's be honest, it's been driven by a pretty narrow group of those mega cap tech and growth stocks. Any sign of weakness from them could, well, expose maybe some fragile underpinnings of the broader rally. It's like finding out your star quarterback suddenly has an off game right before the championship.
That's a great analogy. And on Wednesday, we're looking squarely at Microsoft, MSFT, and Meta platforms. Meta. For Microsoft, the big focus is Azure, their cloud platform growth. And any commentary on AI monetization, how they're making money from it, a material slowdown in Azure, that would be a significant red flag, not just for them, but maybe for the whole sector. For Meta, investors will be scrutinizing digital ad revenue that's like a real-time proxy for business sentiment, how companies are feeling about spending, and they'll also watch the costs. Those AI infrastructure investments are huge.
Okay, huge ones Wednesday. Then Thursday, it's Amazon.com, AMZN, and Apple, APL. For Amazon, I assume it's all about AWS. Amazon Web Services. Primarily, yes. AWS performance is key. Analysts are expecting a strong quarter overall for Amazon. Revenue maybe around $162 billion, up 9.5% year over year. EPS $1.32, up almost 5%. But there's also caution. They might issue a conservative outlook for Q3. Why? Maybe ongoing tariff uncertainties, maybe escalating costs for Project Kuiper, their satellite internet thing, so watch the guidance.
Guidance is key. And for Apple, is it still all about iPhone sales?
iPhone sales always matter, of course.
But for Apple, right now the market's attention is really on their forward guidance. What's the outlook for the next product cycle? And crucially, any commentary on demand trends in China. That market is so important for them. Honestly, that forward-looking statement, it's probably more impactful right now than the backward-looking sales numbers for the last quarter.
Gotcha. Okay, moving beyond tech, the energy sector seems to be under some pressure this week, too. Friday, we get ExxonMobil, XOM, and Chevron, CVX.
Yeah, the energy sector is actually looking like it might be the biggest drag on the S&P 500's overall earnings growth this quarter. The forecast is for something like a 24% year-over-year decline. So beyond just the headline earnings numbers, consensus is about $2.14 for Exxon, $2.55 for Chevron. What's really crucial is what management says. Their commentary on global oil demand, their plans for future capital spending, the impact of geopolitics. Their outlook serves as a key barometer for the health of the whole global industrial economy.
A barometer. Good way to put it. And finally, let's quickly gauge the consumer and financials. Tuesday brings Procter & Gamble, KG, a global consumer staples bellwether, right? Like a leading indicator for how consumers are doing overall.
Exactly. With P&G, we'll be keen to see how they're achieving sales growth. Is it people buying more stuff, volume increases, or is it just them hiking prices, which might not be sustainable long term? Also, their initial guidance for fiscal year 2026 will be watched really closely for their assessment of global market growth. And then you've got the payment networks, like Visa, MasterCard, PayPal. They give us that real-time pulse on consumer spending.
What are we looking for there?
Key things. Total payment volumes, obviously. The mix are people using credit more than debit. That could signal stress. Cross-border spending, that tells us about travel and global activity. And importantly, any commentary on rising consumer credit delinquencies. Are people falling behind on payments? That's an immediate raw look at the consumer's financial health.
Okay, that covers a lot of ground on earnings. Which brings us neatly to segment 3, the Powell Pivot Point Federal Reserve and Monetary Policy. The FOMC meeting wrapping up Wednesday afternoon. This is, without a doubt, the central event, the anchor around which the entire week's trading is going to pivot.
Absolutely. And what's so fascinating here, as we mentioned, is that the market is already pricing in like a near 100% probability that the FOMC holds the federal funds rate steady. Right where it is, 4.25% to 4.50%. This would be the 5th meeting in a row with no change.
Yeah.
So the focus, it isn't on what they do with rates this time. It's entirely on the nuances of the Fed's communication.
The nuances, the hints,
The
signals.
Exactly.
Yeah.
The prevailing expectation is for what people are calling a hawkish hold. That means unchanged rates, yeah, but communication that strongly emphasizes the job on inflation isn't finished yet. They're not ready to declare victory.
So it's all about decoding those subtle signals, especially in the statement they release and then Powell's press conference afterwards on Wednesday. How confident can we really be? How confident can you be that you're interpreting these signals correctly?
Well, that's the million-dollar question, isn't it? And it's why every single word matters. When that FOMC statement drops at 2:00 p.m. Eastern, analysts are going to be combing through it, looking for any subtle changes in the language. A key phrase to watch is how they describe economic activity. In June, they called it a solid pace. If they downgrade that, maybe to moderate pace, that would be seen as a dovish signal. Most critical, though, will be how the committee characterizes inflation now and their assessment of the risk to the outlook. Are they still more worried about inflation, or are risks becoming more balanced?
Okay, the statement at 2:00 and then 2:03 p.m. Eastern, Powell's press conference. This feels like the main stage. This is where we really gauge the Fed's thinking.
This is absolutely crucial. It's the forum to see beyond the carefully crafted words of the statement. Powell will be pressed on several key topics. You can bet on it. First, the threshold for a rate cut. What specific evidence does the committee need to see to gain that greater confidence they keep talking about, that inflation is sustainably heading back to 2%? And, related, what degree of labor market weakening would actually prompt them to move? That hits their dual mandate head on.
Right. What else?
Second, the impact of tariffs. This is interesting because the committee seems a bit divided here. You've got Governor Waller suggesting tariffs might be a temporary one-off price shock. But then Atlanta Fed President Bostic seems more concerned they could be a persistent inflationary threat.
Yeah.
Powell's answer on this reveals the Fed's core reaction function. How do they deal with this kind of supply-side uncertainty? And third, inevitably, the September meeting. Now, he'll avoid pre-committing. He always does. But his framing of the data they need to see between now and the September 17th meeting, that will be a very strong signal. Expect him to hammer home the phrase data-dependent.
Data-dependent, always. Okay, but here's where it gets really interesting. This feels like the potential aha moment for this whole section, the X factor. The significance of a dissenting vote. This could be the biggest potential market-moving surprise, right? And it really clarifies that there are opposing viewpoints inside the Fed itself.
This is absolutely a crucial test of committee unity and something you need to have on your radar. Fed Governor Christopher Waller, he has publicly and pretty forcefully made the case for a rate cut now, in July. His argument is basically that the Fed should act preemptively, support the economy before the labor market shows significant weakness. It's a clear opposing view to the likely consensus. So a unanimous 12-0 vote to hold rates steady, that signals strong consensus behind Powell's patient message. Everyone's on board.
But what if it's not unanimous?
That's where it gets fascinating. An 11-1 vote with a formal dissent registered from Waller, that would be a major development. A dissent isn't just a minor disagreement. It's a public signal of a deep fundamental fissure within the committee about the right policy path. It actually undermines the chair's message, suggests the internal debate is maybe far more tilted towards easing than the official statement lets on. The market would almost certainly interpret a dissent as a strong dovish signal. It would dramatically increase the perceived odds of a September rate cut, almost regardless of how hawkish Powell tries to sound in the press conference. This is where you see those ideas really clash, right there in the vote. Wow. Okay, a dissent would be huge news. So what does this all mean for you and your investments? Let's pull it all together. Segment 4, market impact analysis, your strategic bottom line. This confluence, this mashup of top-tier data, pivotal earnings, a decisive Fed meeting, it creates a really wide spectrum of possible outcomes. It's like all the teams are on the field at the same time. Indeed, it makes things complex. But we can outline a few key scenarios for the major indices, like the S&P 500 and the NASDAQ. Hopefully this gives you a clearer point of view.
Okay, let's start with the good one. Scenario 1, the Goldilocks dovish validation. This sounds bullish.
It would be. This scenario is driven by a combination of, let's say, inline or slightly soft economic data. Think GDP around 2%, maybe that core PCE print comes in cool, and the jobs report is weak but doesn't signal a crash. You couple that with strong earnings, and importantly, strong guidance from those tech titans we talked about. The final catalyst. A Federal Reserve that, holds rates but clearly signals the doors open for September, maybe through a dovish press conference or perhaps even that Waller dissent we just discussed. The result? S&P 500, NASDAQ likely pushed to new highs. And maybe the rally even broadens out a bit, includes some of those lagging cyclical and REIT-sensitive sectors that have been left behind.
Okay, that's the dream scenario for bulls. Now scenario 2, the hawkish surprise. You flagged this earlier. This is the highest risk scenario for you, the listener. Why?
Because the market isn't positioned for it. This outcome would involve a nasty combination. Hotter than expected inflation, maybe core PCE coming in above 0.3%, and a surprisingly strong jobs report, showing the labor market isn't cooling as fast as hoped. This data would then be met by a resolutely hawkish Fed, a unanimous vote to hold, forcefully pushing back against any idea of a September cut. Powell sounds tough. Now, if that gets compounded by a significant earnings miss or really weak guidance from one of the mega cap tech leaders, well, that could trigger a sharp market correction. The critical takeaway here for you. The market's sitting at extreme greed. There's almost no cushion. Any kind of hawkish shock could lead to a rapid unwinding of complacent positions. We could see a 5%, maybe even 10% drop in the major indices as those rate cut hopes just evaporate. Be prepared for this possibility.
Okay, definitely need to be aware of that one. And finally, scenario 3, the muddled middle. This sounds confusing. Volatile, sideways market.
Pretty much. This scenario is characterized by conflicting signals, like maybe you get strong GDP data, but then a really weak jobs report, or maybe hot inflation numbers, but they're offset by absolutely stellar tech earnings. It pulls the market in different directions. And then if the Fed itself sends mixed messages, maybe sounds hawkish in the statement, but kind of dovish in the press conference, that just adds to the confusion, the likely result. A choppy, volatile week, the major indices might end up not going anywhere overall, but underneath the surface, you'd see rapid, unpredictable sector rotation. Definitely a week for active management, not set and forget it.
Okay, so those are the broad market scenarios. What about drilling down? Sector-specific sensitivities. This seems key for developing your strategic plan.
Absolutely. Technology obviously is highly sensitive to both earnings results from its leaders and Fed policy. It needs those strong reports to justify high valuations. A hawkish Fed is a direct headwind. Financials hinge on the interest rate outlook. A hawkish Fed may be a steepening yield curve where long rates rise faster than short rates. That could actually be beneficial for bank profit margins. But you also have to watch consumer credit health from those payment network reports. Then you have the rate-sensitive sectors, like utilities and real estate. They often act like bond proxies, meaning their performance is closely tied to interest rate moves. They'd be the main beneficiaries of a dovish Fed pivot, but they'd get hit hardest by a hawkish surprise. Industrials and materials, those are cyclical sectors, sensitive to GDP growth and global trade news. Tariffs are a factor here. And energy, while mostly driven by oil prices day to day, the commentary from Exxon and Chevron gives us that crucial read-through on global industrial demand.
Okay, that's super helpful context for different parts of your portfolio. So let's bring it all home. The strategic bottom line. What are the key risks and the key opportunities for you this week?
The biggest risk, without a doubt, is that hawkish surprise. The market is simply not priced for it right now, and with the S&P 500 near all-time highs, there's very little cushion to absorb that kind of shock. That's risk number one. The primary opportunity, it lies in that dovish validation scenario. If the data and the Fed confirm the market's optimistic soft landing narrative, maybe validate those hopes for a September rate cut, well, that could remove the single biggest source of uncertainty hanging over the market. It might unleash sideline capital, maybe extend the current rally, potentially even broaden it out. So the opportunity is there too. This week just demands a clear plan, knowing these possibilities.
It really does. This week is truly a period of critical decisions, isn't it? A financial gauntlet, as we said. Understanding the interplay, how the macro data, the corporate earnings, and the Federal Reserve signals all connect. It's absolutely paramount. We really hope this deep dive has equipped you with a clearer point of view, a strategic lens to actually navigate this complex financial landscape. Hopefully, you feel well-informed and ready.
And maybe just one final thought to leave you with as you consider the week ahead. Think about how the market's reaction to all these events isn't just about the raw numbers themselves. It's often about the narrative that emerges from those numbers and about the consensus or maybe the lack of consensus, like with the potential Fed dissent within these key institutions. So how might your own perspective, your own strategy be influenced if you try to anticipate these narratives rather than just reacting solely to the data points as they hit the tape? Something to ponder.
A truly thought-provoking question to mull over. For the fastest and most frequent updates, and to keep getting insights just like this, make sure you subscribe to The Deep Dive. We'll be right here to help guide you through it all.